Well, we're very fortunate to have a distinguished panel with us today, and I think it's an incredibly well-constructed panel, actually, because we've got an international retail and investment bank, two African banks, a regionally large law firm, and an entrepreneur. So we'll have a good kind of overview from many different perspectives to the issues that we want to discuss in this session. But before we start, I'll just let these folks trickle in. Okay. I think that you all are very savvy about Africa and you know a lot about the continent, so I thought I might just start with a little bit of a quiz. So raise your hand if you think that there are more than, say, the same number or more than, say, 50 companies African companies with $100 million in annual revenue. Are there 50 or more? Okay. How about 100 or more? Keep your hands up if you think there are 100 or more. This is $100 million in annual revenue, African countries. How about 250 or more? How about 400 or more? There are more than 500 African companies that do more than $100 million in annual revenue. There are more than 150 companies in Africa that do more than $1 billion in annual revenue. These are African companies. So what I want to do with this panel is first just spend a couple of minutes talking about the African growth story at a very high level and very quickly. Then we'll have a conversation with our panelists, and then we'll open it up to some questions. Okay. So first of all, Africa, as you know, is not a country; it's a continent, and the continent fits many of the world's largest countries within it. Oh, where's my clicker here? Africa GDP right now is about $2 trillion, and the African Development Bank estimates that it will grow 10 times this by 2060. It's enjoyed an annual growth rate of almost 6% for the last several years, with several of the countries averaging over 7%, including Ghana, Zambia, Rwanda, Mozambique, and some others. It weathered the financial crisis extremely well, as you know, with growth rates never going below 3%, even in the worst years of the crisis. And Africa's GDP may soon surpass that of other developing economies. And the African Development Bank, or maybe I think it might have been McKinsey, estimates that there will be $820 billion of new growth by 2020, which is not very far away, in infrastructure, agriculture, and consumer opportunities in Africa. And another important thing to always keep in mind with an Africa GDP story is that the informal economy is about 25% of these economies. So whatever number you're seeing, it's always about almost 25%, a bit more than 25% bigger than that. Six of the 10 fastest growing economies over the last decade and going forward to the next 5 years are in Africa. Some of that, of course, is base effect, and a lot of that is commodities driven, but still it's a very compelling story. And the macroeconomic fundamentals have improved significantly. The external debt numbers started coming down with the Jubilee 2000 effort and the debt forgiveness effort, thanks to leadership exercised by DFID, actually, but also multilaterally. And inflation has come down across the continent, so it's much more positive macroeconomic story. And of course, Africa has always been a commodity story, and still, in 20 countries, commodities are still 25% of total exports. And about 20% of Chinese FDI is still in mining in Africa. And it's the world leader in some very important platinum, coal, nickel, and copper, and aluminum, and some commodities I've never heard of before, actually. But I think the medium-term growth story is really about the demographics, because by 2030, Africa will be the most populous region in the world, with almost 20% of global population. It's also got an incredible demographic advantage in the increase in working age population. Going out to 2050, you can see the working age population surpassing that of Europe and Latin America and Asia. And as was talked about in the panel this morning, it's also the youngest region in the world. So the average age is, I think, 18 years. The median age in Africa is 20 years. and 4 out of 10 people in Africa are less than 15 years old, younger than 15 years old. And it's also a rising middle class story. So there's about 300 million people in the middle class in Africa right now, and just as a kind of a benchmark reminder, that's the size of the United States. That's about 34% of the total population, and that's expected to grow to over 1 billion by 2060 at 42% of the population. So it is, despite kind of the EM volatility over the summer, it is very much a long-term, medium and long-term growth story in Africa, and we'll hear a bit more about the opportunities as well as the risks and how to navigate those risks from our esteemed panelists, to whom I will now turn. So to my very far, my left, Karim Anjarwalla, who's the managing partner of Anjarwalla and Khanna. It is Kenya's largest law firm, but probably more interesting for this discussion, he is also the founder of the Africa Legal Network, which is an association of law firms in East Africa, which has now expanded to 12 jurisdictions and has over 150 lawyers. To his right is Aig-Imoukhuede, who's the Chief Executive Officer of Access Bank, which is a top 10 bank in Nigeria, which Aig started from absolutely nothing and grew to its size. And he was named West Africa's Entrepreneur of the Year by Ernst & Young in 2012. And he sits on more government commissions than I have time actually to go through in this introduction. Sitting next to me is Ayeyemi, who is the CEO for Citibank. It's a small local bank in Africa. And Citibank actually does business in, I think, 12 countries, right? We have branch offices and does business across 23 other countries. To my immediate right is Sara Menker, who is the founder and CEO of Grow Ventures, and we'll hear more about what Grow Ventures do. But basically, it's an advisory business based on commodities and intelligence and data provision around commodities. And then to my last but not least, to my far right, is James Mwangi, who I think is well known to all of you as the CEO of Equity Bank Group, which has the largest base of customer base in Kenya, and started out as a microfinance bank, but has grown to be much more than that. And this is something that I really wish I could ever have in my life, but unfortunately will never happen. He received in 2011 Kenya's highest civilian honor, first class, the Chief of the Order of the Burning Spear, for his outstanding contributions to economic development. So I'm very happy to introduce my esteemed panel. And guys, when you want to talk, press the button, and when you don't want to talk anymore, press the button again. So what I want to ask you, and I'll start with you, Karim, is and I'll ask all of the panelists, how have you seen a transformation in Africa since you've been in business? What are you seeing from your client side and from your own business experience? And where do you see coming out of that the opportunities going forward? Thanks.
Thanks, Staci. Can you guys all hear me? Yeah, great. I went back to Africa in '96. And at that time, it was one-way traffic. I was pretty much alone, and most of my friends and colleagues were looking for jobs in the Western world. The big transformation that I see is the change in the dynamic. So the quality of human capital now available on the continent is profound. So our business would struggle to find people to work for us, and now we have more people applying to us than we probably need. I think that's a fundamental transformation because these are people who are globally networked and globally experienced who now want to work back on the continent or at least in relation to the continent. I think the second fundamental transformation has been around, and a lot of our clients talk about this, around governance and rule of law and predictability. It's sort of constant theme in Africa. Can I have my contracts enforced? Will the government simply change the terms of my transaction? How can I have security that my long-term infrastructure project won't get retraded on me? And I think increasingly you're seeing an improvement. And of course, it's a mixed picture. But talking generally, you're seeing improvements in governance right across the continent. In Kenya, for example, we now have an executive which is sort of American style. So these aren't elected members of cabinet. They are appointed, and out of a cabinet of 18, we have 16 professionals and just 2 politicians. So that just puts a different spin on the way government is government is run.
Certainly better than the United States can say right now.
Right. And we are actually we still have a functioning government.
Now, don't rub it in.
I think the third big theme is regionalization. So Africa is increasingly splitting itself up into about 3 or 4 major trading blocks. You have the OHADA bloc, which is a whole bunch of French West African countries, single legal system across commercial law. You have the COMESA bloc, for example, and you have the East African Community. And these are trying to effectively create, single markets with free movement of goods and services. And I think the final point is just the freedom around, civil society, use of the internet, mobile penetration. I think running to, more than 70%, and that's just, changed the way in which we as Africans relate to each other and to our government, and increase the flows actually between African countries.
Aig, how about you? Can you talk about the development of your bank and where you saw the opportunities when you first started, which was a pretty bold move, and then how do you see the same opportunities now, or how have they evolved?
Thanks, Staci. I think a bit different from Karim is I never left Africa, so I didn't have to return. And because I didn't leave, I think it gives me the opportunity to bring some color to his earlier comments. You see, in the 60s and the early 70s, Africa was this big hope. And indeed, in several respects and along a number of indices, economic, social, and so on, Africa compared quite favorably to, if you like, a number of northern hemisphere, regions. What then happened was that we had this unfortunate dive into military and non-civilian rule. And the frank truth of it is that as far as Africa is concerned, there is a correlation between poor economic performance, poor opportunities to be harvested, and the type of rule you have. Now, round about the time that Karim came back, you saw a phenomenon begin to appear, which was the return to democratic and civilian rule. And it's no coincidence that, frankly speaking, the African story took off with this change. I tell people that retail doesn't do well with military dictators. It just doesn't. And there are a number of reasons, for that. Now, in terms of Access Bank, I worked for what was a very high-performing corporate-focused bank called GT Bank. And I think, to a certain degree, it still seems to, gather a lot of respect internationally for what's done in Nigeria and other countries. But for me, I saw that, look, in 1999, we had the return to democracy. And I saw that, there was a very, very high possibility of some economic renaissance taking place in Nigeria, and I wanted to catch it. So timing-wise, around about 2000, I was number 3 in Guarantee Trust Bank, which was a good place to be as a professional. But then I thought, look, if I'm a professional in a bank, I missed the entrepreneurial opportunity to catch, the real wave of banking that would take off. And so in 2001, we bought this obscure institution, thinking that even if we simply did things properly, ran a bank that provided significant value to the various markets that we served, as Nigeria took off, we would take off with it. And Nigeria indeed took off. And our timing was fantastic because telecoms and a number of segments like cement and so on really ran with it. And in that process, we bought a few banks along the way. So we went from being number 70 in a 90 bank community to being number 4 in 10 years. And yes, a lot of it is what we did internally, but the reality is that we just rode, the Nigeria, the African story. And that's the contribution.
Let me turn to James, if you can now tell us about this. Tell us about your experience with Equity Bank, and also the same kind of. Do you see the same opportunities now that you saw then, and how has that evolved?
Thank you very much. I think the story that we have seen in East Africa is very similar to what we have had for West Africa from the legal perspective. For us, Equity over the last 20 years we have experienced a tenfold growth every 5 years. A dollar that was invested 12 years ago in the bank is now $1,300. What has driven that huge transformation? I think the biggest driver of change has been reforms. I think people underestimate the reforms that the continent is going through. Political reforms, like we have had the democratic reforms, legal and structural and economic reforms, and to a great extent, social reforms driven by education, health, and other social facilities, access to that. We have seen in the last 7 years, 2005 to 2012, the bank growing from a balance sheet of 5 billion Kenyan shillings to 300 billion shillings. Again, reflecting that mid-row income that is rapidly growing in Africa. The consumer, the purchasing power is becoming very significant. And lastly is the change in infrastructure. I remember 10 years ago, we had branches that had not been connected to the national grid and could not even have a phone. Today, you find you don't even need landlines. Every person in the population, or for every 3 people, 2 have their own phones. And 10 years ago, a whole branch would not have a phone. That is the kind of transformation we are talking about. I think going forward, I would say we'll see maybe more accelerated growth. One of the biggest aspects that I'm seeing is what was formerly a brain drain is turning out to be a major brain gain. And the experience and exposure of the thousands of Africans who are returning back home is helping to build the capacity of the population. I think increasingly we are seeing the previously small markets, like Kenya, 40 million market, quickly opened through integration of the East African community to be 120 million market. And suddenly, with the same legal framework, with the same policy, and suddenly you find both from a demand side perspective, then you find it's almost institutions are gulping to cope up with the opening opportunities.
Thanks. Now I'd like to turn to Ade and then also to Karim to talk about, do you think that that this kind of transformation is recognized by your clients, your international clients? Do they kind of have the story right on Africa?
Thank you, Staci. I think it depends on who you're talking to in terms of our client base. I was in Ethiopia, I think, during the AGOA conference a couple of weeks ago, and there was a statement that if you take 200 Americans that has never been to Africa and you ask them to talk about Africa, they tell you horror stories of things that they don't want to witness. If you talk to 200 people that have actually been to the continent and they come back and they actually give you their experience, it's a 2 different things. And you wonder whether those 2 sets of people are talking about the same continent. And they are, because the question of perception and then reality. Our clients that we talk to, the ones that actually have done business in the continent, can recognize a couple of things. And I give you, if you go back to 2008, across the whole of the East Africa seabed, there was no fiber connectivity to the rest of the world. So if you want to do phone, it has to be by satellite. And we know how quick that is. That's the first data point I will give you. If you go to Nigeria, go back to 1999, there are 300,000 landlines in a country of over 100 million people. Again, those things have changed. If you go back to air connectivity, if I want to connect between Nairobi and West Africa or Johannesburg and the rest of the African countries, I have to go to Europe and then come back. Now, those things, you can now go point to point. Are we at the point where we can say everything is smooth? No. Have there been progress? Yes. Are the clients seeing those progress? Those early progress, the clients are seeing, and they're making it the basis of their own investment. If you go to the various ministries, as Karim said, you look at Kenya, you look at other countries, but you go to ministry, the people that sit on the other side of the table can actually be a private sector person. So the kind of conversation we're having, that our clients are having, we are having with our clients, are more different with the conversation you have historically. So I think if you put all of that together, it tells you that there's a real progress in terms of institution forming, there's a real progress in terms of business practices. There are still challenges, of course, but the clients are seeing progress and they are investing in those early progress.
Mm-hmm. Karim, do you have anything to add that from your client perspective on terms of capital and?
Yeah, Staci, I mean, I think, there are sort of, really large companies who are taking, who've managed, I think, to fix what I call this perception of risk versus the reality of risk question. It's a constant frustration for us in Africa to explain some of the changes that we know have happened, but which, investors on the whole take a long time to catch up on. But if you look at sort of the investments that, say, people like Diageo have made in Ethiopia, where Sara is from, the sort of investments that people like SAB Miller are making, Bharti Airtel's acquisition of the Zain network. There's a great company called Godrej Consumer Products. This is sort of a mini Unilever of India, and they bought a African hair care business across 16 countries. Right? Helios and Vitol bought Shell's downstream assets in most of Sub-Saharan Africa. All great examples of, and then if you look at slightly longer term projects, the East African seaboard was the only continental seaboard that had no fiber optic cables, right? 6 years ago. And now we have 3. And a lot of those run through a multiplicity of countries. So yes, it is difficult to do infrastructure projects in Africa, especially many countries, but those cables tell you that it can be done. So I think there is a change, but there's a lot more that needs to be done around fixing the risk, the mismatch, if you like, between the reality of risk and the perception of risk.
Yeah, I think that's a great segue to what I want to talk about next, which is to drill down a little bit deeper into the actual risks on the continent, the perceived risks on the continent, and the opportunities on the continent, some of which are generated by risk. I mean, risk is like rain, right? I mean, you're a bit nervous to walk outside in your new outfit, but if you have very good weather forecasting, then you can, you're better off. And if you have a raincoat and an umbrella, you know how to deal with the risk of rain, then you're also better off. And then also some people can, like Sara, can make money selling raincoats and umbrellas to help manage that risk. But I just want to give you one quote before we turn to this topic, which is that the G20 report in 2012 said that the cost of capital in Africa assumes a non-performing loan rate of 15%. And the non-performing loan rate in Africa is actually 8%. And that misperception of risk in terms of the cost of capital costs $9 billion annually to the continent. So it's these are large numbers to get to getting that right. But Sara, let me turn to you and talk about some of the market imperfections and risks on the continent and how you're creating opportunity for based on that.
Thanks, Staci. So, I mean, I describe what we do as we're an infrastructure company, but the infrastructure we provide is real-time data. And in having this discussion about perception of risk versus reality of risk, one of the things that became very apparent to me when I started looking at investing in Africa on the agricultural sector specifically initially was that the inherent cost of capital for doing any sort of agricultural project was just way too high. And the reason that's too high is that if you go to a bank, the interest rates are too high. There's no such thing as crop insurance, or if there is, it's a very small market. Logistics, companies don't exist in scale for you to move your products to market. At the bottom of all that, there's basically a need for real-time data for us to really assess and understand risks. And we operate off the theory that if we're able to provide that real-time data to banks, to insurance companies, to logistics companies, to anybody really that wants to participate in the ecosystem of the commodity space, they're able to mobilize their capital in a far more efficient and more scalable manner. And I mean, some of these risks are real, but you have to contextualize them within the context of policy. So one of the things we focus on is not just the underlying numbers, but also how does that fit within a policy framework. So to give you an idea, Africa today exports $2.7 billion of coffee a year. Germany, which doesn't produce a single bean of coffee, re-exports $3.7 billion a year, of which 50% of that is green beans. Unprocessed, they just take it out of the bags, repackage it, and ship it back. So if you're a coffee buyer in Kenya that's not of enough large scale, you're actually buying your green Ethiopian beans from Germany and not from Ethiopia, right? And these are market arbitrages that exist, but unless you're really looking at the ecosystem piece by piece, you don't identify. So I think, the reason I started the company and what we do is helping decompose that so that we can understand where the breaks are. And I say, basically today Africa is a margin game because everybody only wants to go in if the returns look exorbitantly high. We want to swap the margin for volume so that everybody can get a smaller piece of a much bigger pie.
James, how about you? How have you thought about and how have you addressed this kind of better understanding mitigates risk in terms of your own business? And what kind of advice would you give to people interested in doing business or investing on the continent?
I think one of the biggest challenges about Africa is information symmetry. And as Salah has just said, I think Africa risk is heavily perception-driven, and perception is informed by limited access to information. The data is not really accurate. Essentially for us, what we have tried to do is to try and invest significantly to getting people on the ground. If it is the distribution or supply chain, saying maybe setting up distribution using brick and mortar is not the solution. What about if we focused on existing retail outlets to become distributors of financial services? They have almost perfect information about the villages and the localities they are operating on. And amazingly, you find while it cost me 97 shillings to deliver over-counter transactions, these retail outlets are comfortable and make money when I pay them 14 shillings for the same transaction. So essentially, you see, it's the information, it's the understanding of the market and the risk and the mitigations that really drive the decision. So I would say it's trying to go deeper to the field to get real time. I think, as one would say, sometimes it may require you to lose $100,000 to buy deeper understanding and knowledge, other than to preserve $100 and miss $1 billion opportunity.
It's just a tuition cost, right? Could I have slide 17? So, everybody, if you're not in South Africa, the next country that you always think about is Nigeria. But it is not the case that there are no problems in Africa. And so this is a survey that Ernst & Young did that talks about the top challenges to doing business in Africa. And some of them are, Nigeria kind of is spoken about in terms of some of these, but it's also such a large economy that it can't be ignored. And so how should we be thinking about Nigeria in terms of the risk opportunity matrix in particular?
Thanks, Staci. Where's this survey from? Ernst & Young. Yeah, I think I would agree with everything up there as issues or challenges to be overcome. I think I want to talk to the corruption issue. And I don't want to talk to corruption from the obvious standpoint that from a values perspective or morality perspective it's wrong. I want to talk to it from an economics or a finance perspective. Essentially, what corruption does in Africa is that it it causes government and sometimes even the private sector to partner to make wrong decisions, decisions that are selfish and seem to suggest in the short term a benefit to a very narrow set of people, but have a very hurtful impact on the overall economy. And in terms of the long term and the bigger picture, actually, you're shrinking the pie. So when you see the issues of ease of doing business as a challenge, you hear of the structural bottlenecks as a challenge, and so on. At the end of the day, you can trace it back to simply two things. A selfish individual motivated by reasons other than, value to the system, or a lack of capacity because the right people can't occupy office, not because there aren't people who can't do these things, okay? It's just simply that the right person, doesn't get there, okay? And so I'm going to give you a few examples of what happens when you take corruption out of the equation, okay? I'll give you one. The first is telecoms. Now, if I remember growing up, if I wanted to make a phone call outside Nigeria, literally everybody in Nigeria would have to go to Lagos. You'd have to go to the telecoms monopoly. I can't remember what it was called then. And you'd queue up, and you'd wait for your call, right? And this is real, okay? And we then struggled with trying to introduce mobile telephony, trying to privatize it and so on, or commercialize it, all within this military dictator, type scenario. So anybody who came in was a friend of a dictator or somebody who could sit down and dine with the devil kind of thing. So that kept out the people who wanted to add value, the people who had decent models to play and so on. Now, with democracy, the democratic regime thought, okay, one of the low-hanging fruits is to address the issue of telecommunications. What did they do? What is the best technology for telecommunications for a population then of 130, 140 odd million people, given our demographic realities in Nigeria? GSM. Simple. It was there. It's been there. It's been available, but the military didn't take that choice. Now, let's get one private sector guy who can sit down and administer an auction where the best people, would win. And so we had a transparent auction, okay? And let's have a regulator who understands, the rudiments of regulating a telecom sector, et cetera, et cetera. So very quickly, overnight, you went from a sector that was badly governed and badly administered to a sector that was reasonably governed and reasonably administered. And so I have a phone, and once I had the phone, I could make a call, and call anywhere in the world without having to queue up. And of course, thus far, 100 million Nigerians have bought these phones. And so you see a sector and a country that had 500,000 phone lines cap for 40 years, and 10 years after the change, now has 100 million phone lines, and by the way, has created the greatest wealth in the telecom sector globally, in one country. And this has happened in cement manufacturing. So this has happened in banking. So every time, and I'm not even saying that you have this massive reorientation on the corruption issue, every time you tackle it in any aspect of our economy, it takes off. And it takes off to the point where you have a globally attractive return. And for that reason, I, as an individual, and my bank has taken the decision, not altruistically, even in our own interest, to say, look, we have to push the argument. We have to be flag bearers for the argument that do the right thing. When you do the right thing in Africa, Africa prospers and we all prosper in the process. Thank you.
Ade, would you like to comment?
Thanks. I agree with what Aig said, and I just want to put a couple of things to you as well. Because I work for, as Staci said, a small bank, which is Citi, across Sub-Saharan Africa. When people ask me the question, do you have a business in Nigeria? I say yes. How much do you guys lose due to fraud? When I tell people it's almost zero, they don't believe it. And they can't believe it because if you look at Nigeria, it's fraud that people actually look at the biggest risk. That's the first thing. The second question is, do you guys work with government? I say, yeah, we work with government. We've done 13 of the sovereign bonds that has been done in the last 3 years. We've led 13 of them. And So how do you get these deals done? Because we bid, we put up a process forward. And what I'm trying to say is you can be a global company, follow your global practice, not participate in the corruption, and still be able to do business. Citi has been in the continent since 1958, okay, and we manage to do business in almost all the countries, and we can pride ourselves we are not paying anybody to get it done. Of course, we have to, it is not a shortcut, okay, because you have to make sure that you prepare well, prepare better. But as I said earlier on, the people on the other side of the table are now becoming sophisticated as well, and they can listen to us. There are other risks that exist, of course. You know, it's not just the political risk and co. It's not a big deal. I mean, there are currency issues. There are the question of devaluation that one needs to worry about. But some of the risks we worry too much about is not actually what we need to worry about. Thank you.
Okay, I think that's a good pivot to talk about this kind of dichotomy between, you know, on the one hand, Africa is not a country. There are good performing countries and not so well performing countries. And an economist will tell you that the good performing countries should, of course, attract more capital naturally as market forces work. Versus the other sort of, and I think more recent argument that just for economies of scale reasons, you actually have to think about Africa in terms of a regional play or almost a continent play. And I'll just read a quick quote from Mo Ibrahim, who says, you know, you talk about Africa, we have 54 countries. That's a problem. Do you know why China is where it is and Africa is not? Because China is one. If we were one, we too would be there. That's why regional integration is essential for Africa to really have a place at the table. So I want to kind of flesh out this this topic in terms of, you know, what do you do when you're in a country, based in a country like Nigeria or a country like Kenya, but you have to pay attention to your neighbors as well. What kind of model is that for expansion? What are the sort of quick wins for regional integration that will deliver, you know, excess kind of bang for your buck? And how should we think about approaching policymakers at a regional level? I mean, it's not, you know, to kind of paraphrase Henry Kissinger, when you call up the EAC, who answers the phone? So Karim, maybe I'll start with you, kind of because the legal infrastructure is so critical for these kinds of questions.
I think one of the easiest places to start is to, in fact, just enforce a regime which already exists. Part of the weakness with our regional structures is that we have, for example, in the EAC, a treaty which is supposed to guarantee the free movement of goods and services and capital. But in fact, particular countries will you know, on the ground. So when you're moving your goods between Kenya and Tanzania, you know, the Tanzanian government will impose a duty structure on your goods, right? And that's in breach of the treaty. So one of the easiest things to do is to, in fact, just push the enforcement agenda. And of course, this has happened before. The EU had to do this, and EU countries had to do this in order to make the common market, you know, effective. Right? So, you know, without actually pushing for structural reform, just working with the existing system will, I think, yield, you know, big results. The second thing, I think, is getting governments to focus on their areas of comparative advantage. Now, everyone in East Africa wants their own stock exchange. And you know what? Burundi and Rwanda, you know, even Uganda, they just don't have the scale to have a fully functioning stock exchange. So someone's got to sit down and agree to say, right, it actually makes sense for us to have a regional exchange. And you know what? We have 50 listed companies in Nairobi. We have 7 in Tanzania. You know, is this something really we should be discussing, right? And how do you get buy-in around, you know, that loss of sovereignty, right? So I think comparative advantage is another good way of pushing governments to take some of these big decisions around where to locate bits of infrastructure. Yeah.
Sara, can I turn to you for some comment?
Okay, to just piggyback off of some of the things Karim discussed around, you know, the creation of regional stock exchanges, similar argument exists for commodities. You know, there's a lot of discussion today in Africa around the creation of commodity exchanges fueling the wave of growth, when in reality, no one market is large enough in and of itself to really to really fuel that growth. And more importantly, commodities exist within a global context, and that understanding needs to be built. And I think one of the things is advocacy needs to be, basically there needs to be a lot of advocacy directly towards governments for governments to recognize that not each one needs to be their own champion. You see this in refining. I mean, one of the big growth stories across East and Southern Africa today are the large oil and gas discoveries that require a significant amount of investment in infrastructure. To give you an example, Mozambique went from a country that was completely insignificant in the gas space to last year having the world, the fourth largest reserves in natural gas in the world. In the next 5 years, $20 billion will be spent on just developing LNG infrastructure in a country with a GDP of $14 billion. Now, when you're doing all that, there needs to be some level of integration and understanding that having a neighboring Tanzania, it might make sense to pipe some of that gas into a bigger infrastructure because they're close enough. It might make sense to actually get power from southern Tanzania into northern Mozambique than it does from trying to get the power from Mozambique up into Tanzania. You have a lot of these issues, and there needs to be, I think, vocalness by the corporates on the ground as well around, why the economics make better sense for everyone and the countries involved when there is cohesive thinking around infrastructure. Same goes for refining across East Africa. Kenya wants its own refinery, Uganda wants its own refinery, Ethiopia wants its own refinery. It simply just can't happen that way. Everyone will lose money.
Do you have any comment, James, on how you think about continental expansion, if at all?
I think the challenge of integration, particularly for Africa, started with the political regimes that were insecure. And that insecurity extended to almost blocking countries, developing infrastructure that was interconnectedness. So it is not more about basically changing policy. You change policy overnight. You can easily do that policy change overnight. But developing the infrastructure that enables trade between the countries is where the biggest challenge is. No railways, no roads. Everybody thinks of a railway line and think of their own country. I just imagine of a possibility, for instance, of a high-speed railway line crossing from East Africa to West Africa and the implication it could have on the continent. But you find that is not an idea that is entertained because everybody is thinking inwardly. So I think that, to me, is the biggest challenge. If you look at power, you find countries that have no capability of developing cheap energy still are struggling with thermal plants instead of working with the countries that have competitive advantage of developing even things like coal. So those are some of the challenges that we have in the continent. Physical barriers, policy barriers, but all that emanating from insecure political regimes that across nation was a way of sustaining themselves in power.
Yeah, it's maybe losing a couple of battles to win the war. So as promised, I wanted to leave 15 minutes for questions from our audience, which I'm sure you'll have good questions despite the fact that not everybody did that well on my quiz in the beginning of it. So if we can just raise your hand and move to a mic if you've got any questions for the panel. Yeah.
I take the panel's point that Africa's now much more open and corruption is much less. But the experience that I've had is that when the corruption door is closed, the door that you used to be able to pay to get something done and then magically it would get done, you're now left with a regulatory regime or a legal regime that is grossly inadequate for whatever is trying to be done and has to often be reformed, let's say if it's in housing or in financial services or in power, and that there's a big investment that has to go into creating a new regime that is up to international standards or even somewhere close to international standards to allow investment to flow. Is that the experience that you have had as well?
Thanks. I think, first of all, it's a necessary first step to close the corruption door, okay? Because the most sophisticated regulatory regime with the, Menkers and so on, as the central bank governor in a corrupt country, it's not going to go anywhere, okay? So I think the first step is, you close the corruption door. And there is a recognition that it's difficult to attract very good talent into a public sector that was previously, if you like, enveloped or clouded by corruption, okay? So there is going to be a period of time, okay, as you begin to get talented people to agree, to enter into these regulatory positions, okay, as well as the need to, of course, build the appropriate framework to suit the country circumstances, because you don't just import, something that looked good in Saudi Arabia into Nigeria, for example. What can help, though, is, and I think there's a lot that comes from the more developed economies, because you have the multilateral agencies who are prepared to bring in financing for the purpose of building capacity. You also have exchange programs, and that type of thing. But we would have to be patient. We would have to be patient, because as far as I am concerned, a corruption-free but regulatory weak environment is much better and more attractive from an investing standpoint than a regulatory strong but corruption-ridden environment.
Any other questions? Yeah. Oh, no.
Thanks, Staci. Just to comment on the issue of regional integration and the slow implementation of some countries in Africa. One thing that we are finding, I work for the African Development Bank, and I head the Regional Integration and Trade Division there. One thing that we find in terms of reluctance to actually implement some of the agreements that member countries are party to emanate from the fact that they are worried that they may be the losers. As you know, in this situation, there are always winners and losers, and there are few countries that are dominant. In East Africa, Kenya, Burundi will be afraid to say, Kenya is going to run over and will be the main beneficiaries and will lose out. Now, the challenge for us going forward is then to say, how do we then structure or have these agreements to reflect that some countries can also benefit from these agreements. So it will require some of these, the so-called winner countries, your South Africas, your Nigerias, your Kenya, to make concessions so that, for example, I'm trying to think that if we're going to come up with a regional agreement on, say, investment, to also try and see how do you then encourage investments from Kenya, investments from other countries to also invest in countries that are potential losers. What are the trade-offs that you should provide to these smaller countries? And I find that most of the time, unfortunately, we do talk to governments, and there is need. I think one of the panelists, Sara, said about corporates actually having a more vocal voice in trying to talk about some of these the advantages of not having each country having its own, say, refinery. I think we need to hear that voice more. Most of the time we're talking to governments, and governments are looking at the issue of, I've got jobs, and if we open up, yes, we've signed up to this agreement. If we open up, we're going to lose our jobs. So how do we deal with that, and how do we also try and get the private sector to come on board, to come and advocate some of the business type. Help governments make some business type decisions when it comes to implementation of some of these regional agreements, including the exchange of skills across borders. You get one country which has a lot of teachers, the other country doesn't have teachers, but yet we are being told no, security reasons, and tell me what security threat teachers pose, and just to encourage, lobby governments
Yeah.
that some of these areas need to be addressed.
Yeah. Paul, did you want to make a comment on the back of that? You, I didn't see you in my morning session this morning at 7.
Yeah. The hotel didn't wake me up, unfortunately. So I'm very sorry about that. Yeah, my name's Paul Hinks. I'm the chief executive of a US, although I'm British, a US company, power company. I'm also the chairman of an organization in Washington called the Corporate Council on Africa, which is the largest organization, not-for-profit organization, membership organization that promotes trade and investment with Africa. So I've been working on the continent for about 30 years, so I know a little bit about it. First, what I would like to say is you were dead right. Africa is not a country. Africa's 54 countries, and some are doing spectacularly well. Some are still failed states, but there are opportunities there today which are immense. Now, if you go back and you look at what the place was like 20 years ago, 30 years ago even, the problem is that a lot of these countries, and Nigeria is a great example of that, they're suffering from the hangover of the reputational problems they had in those days. We've made pretty large investments in Africa in the last 2 years, 2 to 3 years. In Tanzania, we own 3 power plants, and we're the largest independent power producer in that country. We have never paid a bribe, and we've never been asked for a bribe. In Nigeria, we've just completed the privatization, a bid for the privatization of the electricity system in the country. And I can tell you that even 10 years ago, 15 years ago, you said to me, go and work in Nigeria. I wouldn't even get on the plane because of what I'd heard about the place. But 2 years ago, I started going to Nigeria. It's now probably my favorite country to visit from a business standpoint in Africa. Is completely different than everything that I heard. And throughout the privatization process, the bid to completion, where we acquired a 972 megawatt power plant, we didn't get asked for a bribe, we haven't paid a bribe, and we won. So, and that's Nigeria. So I'm not saying Nigeria is free of corruption, it's not. Nowhere is free of corruption in Africa, but there's plenty of other places outside Africa which are corrupt too. And I think the point I'm trying to make is that for anybody who's interested in going to the continent and doing business there today, it really is a very, very different place. And as you say, you ask 200 people who work on the continent and 200 people who don't know the continent, and you'll get 2 very different stories. Well, I'm definitely from the 200 that work on the continent, and I would recommend that anybody who's in this room, I'm sure they're here because they have an interest in Africa, I would actually go out there and start seeing what it's really like on the continent. And the people on this panel are examples of the quality of what you describe as the human capital. All these people have gone back to work in their home countries, and it's making a huge, huge difference. Thank you.
Okay, with 5 minutes left, we have a tradition at the Milken Institute to do a lightning round of questions, and this lightning round was inspired by me reading on the web James Mwangi's 10 rules for success, and 2 of them I liked. One was be enthusiastic, and the other was be patient, which I thought was a good combination. So I'll go down the line of our panelists and ask, what does it take to succeed in Africa in kind of 45 seconds or less? So, Karim. I can start on the other end. Shall I start on the other end? James.
Thank you. The first one is unique perception of risk and a reality check for your risk appetite. That is essential for success in Africa. The second one is tolerance. Ideally, there is unfair judgment against Africa. When one goes to do business in America, you're doing business in a country that has been established for over 200 years. When you go to Switzerland, it has been a state for 600 years. You go to Kenya, it has been only a state for 50 years. So when you do comparison of like for like, it can't work, and that is what drives perception. You should imagine yourself as an investor in the US 150 years ago and compare with Africa, and then appreciate how advanced Africa is. Thank you.
Okay, Sara, what does it take to succeed in Africa?
As somebody that recently returned, I went back 1.5 years ago. I think one is resilience. It's not easy, but I think you have to basically understand that things don't necessarily go according to a book that you were given and the way you operated elsewhere. So understanding that things operate differently and recognizing and moving on with that will get you a long way. The other is actually looking at everything that's viewed as a challenge. So improve, transport and logistics infrastructure, recognizing those challenges as opportunities. I think that will lead to very long-term success and great returns for people that can basically switch the lens of challenge to the lens of opportunity and look at it, how can I make money doing this? How can I make money fixing this? I think that's the long-term success story of Africa.
Yeah, terrific, inspirational. Aig.
I think one thing I would say is informed courage. Informed, you have to make sure you get your data, you analyze the data, you put it within the context, and then you have the courage to act on that data. Because if you have the information, you don't act on it, it's useless. If you act without the information, that is dangerous. So what I will tell people is that you need to have informed courage. One has to be able to understand that Botswana and Zimbabwe have exactly the same natural resources, the same landlocked location, and Zimbabwe is the worst in Africa. Botswana is one of the best. So being able to have that information and being able to act on it, I think is one key thing that will make you to be successful. Thank you.
Okay, Aig's rules for success in Africa.
Well, definitely, I would say the first thing you would have would be courage or boldness. But I would say your courage has to be backed by strong conviction. I mean, the people who do well in Africa do well because they believe strongly that they have a business model or an idea that will bring value to the continent. And I've seen it so many times. I've seen great companies come in, but they lack conviction, and it just doesn't happen. The next thing is, I think, very key. Also, another differentiating factor is the issue of local understanding and partners. It's very, very difficult to parachute in and think you're going to operate in Africa, without a local partner or, a very good lawyer. You pay me the fee afterwards. And then the final thing is, I think that the tipping point really in Africa is outstanding talent. And if you can get it local, it really helps. But I think at the end of the day, the execution of this huge opportunity boils down to talent. Now I'm speaking simply as an investor myself. So these rules play whether you are local or whether you're, a foreign investor. Thank you.
Karim, rules, how do you succeed in Africa?
I think two things. We're not that different. And I think there's a sense in which, we need to move Africa from the esoteric to the more mainstream. So, there's this whole myth about the exceptionalism of Africa. So sometimes clients will come and see me and say, well, how do we get this done? And I say, well, actually, doing an M&A deal in Africa, or at least in Anglo-Saxon Africa, is, as to 95%, the same as doing it in the United Kingdom, say. So I think just getting your head around the fact that we aren't that different in many ways, is a starting point. The second thing where I do think Africa is different, and it's now similar, I think, to parts of Southeast Asia, is the need to invest in relationships and face-to-face human contact. So too often clients will say, listen, let's just have a conference call with the regulator. And I say, well, actually, that just won't work, right? I mean, that may work with the SEC in the US or the FSA here, but you actually need to get on a plane, come and meet the regulator, and make him believe that you are for real. And so I think that is probably one of the big differences between dealing, in more developed Western economies where, frankly, human contact is now less essential because institutions speak for themselves. relationships, I think, drive a lot of decision-making in Africa.
Well, that's a terrific way to end, and please join me in thanking our panel for their insights.